सेव किया था ना?
मैं सिर्फ इसलिए गया था क्योंकि उसने मुझे कॉल किया, that's it. But listen तो.
Save it for someone else.
जिंदगी में सेव करना जरूरी है, मगर जब बात पैसों की हो, सिर्फ सेविंग से काम नहीं चलेगा। इक्विटी म्यूचुअल फंड्स में इन्वेस्ट कीजिए और अपने सेविंग्स को आगे बढ़ने का मौका दीजिए।
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Hello and welcome to this episode of Macrosutra. As you can see, it's on Zoom this time, and that's because unfortunately I have COVID. But here at ThePrint, we don't let things like COVID stop us, so the show goes on. But now, before we get on with the show, I wanted to make an appeal to you, which is please do subscribe to ThePrint. It's through your subscriptions that allow us to do the kind of ground reporting that we do, bring you stories from all over India that nobody else does. And it also gets you a whole bunch of benefits, such as the subscriber exclusive webinars that we do, where we get experts to come and talk about the news of the day. You get to write into us in our Your Turn section, where we publish your opinion as an article in ThePrint. And of course, you get access to our subscriber exclusive newsletters that go out from our editors to all of you, where all the editors, we pick out the important stories of the day and we write a little bit about why they're important, and we send it straight to your mailboxes. So please do subscribe. The link is in the description of this video. That being said, now let's get started with this episode. What we're going to be talking about is what the RBI in various reports has to say about India's financial stability, how it is, and what it looks like as we go in 2024. And to discuss this, as always, we have with us Radhika Pandey, Associate Professor at NIPFP, who's gone through both the reports and is going to tell us all about them. Thank you so much, Radhika, for joining us.
Thank you, Sharad.
So now, Radhika, first off, let's start with what the two reports are. What do they deal with? What do they encompass? And what can they tell us?
Yes, so in the last week of December, the RBI released two reports. One is the report on trend and progress of banking in India, and the other is the RBI's financial stability report. Now, the former, which is the report on trend and progress of banking in India, tells us about the state of banking in the last financial year, that is 2022-23. It tells us about how much the balance sheet of scheduled commercial banks rose, what was the increase in credit, what was the increase in deposits. It also talks about NBFCs, the non-bank financial companies. So it's a very comprehensive report telling us about the growth of banking, the growth of NBFCs, the growth of other segments of financial system. And it also talks about it gives the global backdrop. What are some of the changes that have happened in the global financial system that could have a spillover impact on the Indian financial system. So that way, it's a very comprehensive report because it gives a lot of data about the balance sheet position of banks and NBFCs, which we don't get elsewhere. It's So that way, it's very comprehensive. The other, of course, is the RBI's financial stability report, which is an assessment of stability, which is an assessment of what is happening to the asset quality of banking sector, what is happening to the, again, talking about balance sheet position of banks, but it delves into the first half of this financial year. So it's talking not just about 2022-23, which the previous report talked about. It's talking about the developments in the banking sector that happened across the first half of the financial year, that is from April to September of the current year. So that way it is more updated, and again, it's talking about the global developments in the banking sector, in the other NBFC sector in the first half, and then it's talking about the developments in the first half in the domestic financial segment. Mm-hmm. So it has three main chapters. It has a chapter on risk, both global and domestic risk. The second chapter is about the domestic financial system, where they talk about NPAs, talk about profitability, capital position, and they do a lot of scenario analysis. On under what situation can banks face headwinds.
Right.
The capital position can come down or the NPAs may rise. So it's a very comprehensive report in that sense. And the other chapter is again on the various regulatory developments that they have done. For example, they increased the risk weights in November. Whatever regulatory changes they have made over the course of the first half of the financial year, all that is summarized in the final chapter of the financial stability report.
Okay, so now let's start with, when we talk about financial stability, of course, the first thing that comes to mind are the banks.
Right.
So let's start with the banks. So what does the RBI, what's the sense that you get that the RBI feels about the health of banks, the quality of their assets, and whether it's becoming healthier or is it now peaking and it's again coming down?
Yeah. So if we look at both the reports, the general sense we get is that banks are resilient and they have the ability to withstand shocks, which is in contrast to the global banking landscape, because there we saw, we talked about that also, the SFB crisis, the banking crisis that happened, Silicon Valley Bank crisis that happened in the US,
Right,
where the interest rate, because of the interest rate risk, the banks suffered. So all those kind of risks are lesser in the Indian framework because of the regulatory prescriptions, and also because of the investment profile of Indian banking sector is much different from the investment profile of the foreign banks.
And this is something that we've also talked about, right? When the SVB collapse happened and when the crisis happened even in Europe, we talked about how our system was actually quite resilient.
Yes, because our system is mainly based on household deposits, and our assets are also not too much in available to sale securities, but in held to maturity. So it's less immune to the day-to-day fluctuations in interest rates that happen. What was the main reason for the crisis in March 2023 in the U.S. Banking sector? So the general sense is that there has been an improvement in banks' overall asset quality, because now we see the GNPA, which is the gross non-performing assets as a proportion of advances or loans, has fallen to 3.2%, which is an 11-year low. So the GNPA ratio of banks has fallen to 3.2%. The net non-performing asset ratio, which is once we exclude the impact of provisioning, that has fallen to 0.8%. So, we have seen a significant improvement in the asset quality of banking sector. That is one key takeaway. The other is that the capital position of bank has improved a lot. So the regulatory threshold is 11.5%. Whereas for Indian banks, it is now 16.8%, which is quite above the regulatory threshold. So even under adverse stress scenario, the expectation is that banks will be able to meet the regulatory thresholds of the capital position. So that is the second key takeaway. And third is that profitability is high, and that is because we've talked about this, that net interest margin of banks have risen, because last year we saw a period of sustained interest rate hikes by the RBI, and which has a faster transmission to lending rates. So the lending rates of banks rose, deposit rates also rise, but not at the same pace as lending rates. Therefore, the margin between the return on lending and the cost of deposits increased, and that was one reason which led to increase in profitability of banks. The other is that because the bad assets were lower, so they have to do less provisioning.
Right.
Yeah, so they have to set aside lesser amount of their capital, and that also boosted their profitability. So various profitability metrics they talk about, like return on assets or return on equity, or just PAT, which is profitability after tax. So all these metrics show record high numbers. Though given, going forward, now there are some concerns, but As of
Yeah.
now, so as of now, the position is quite good. It is in terms of all performance indicators, Indian banking sector is resilient, and that is what is being talked about in both the reports.
Right. And now, as you mentioned, that going ahead, there are some concerns. There are a few. Even I had gone through the reports, and I read your article as well. The first one is again something that we have been talking about, which is the rise and the growth of unsecured loans.
Right.
The RBI has also been talking about it earlier, but now it's codified it in a report.
Right.
So what does it have to say about these?
Yeah, so they've talked about, the compositional shift in the bank's credit. So what is happening is that if we look at the overall classification of banking credit, it has been geared towards loans to services and retail loans. So agriculture and loans to agriculture and loans to industry has been subdued. It's not picked up at a very fast pace. On the other hand, loans to services and loans to personal, retail segment has grown at a very sharp pace. And there they give some numbers, particularly the retail loans. They say that, in a span of 2 years, that is September 2021 to September 2023, retail loans have grown at a growth of 25%, whereas the overall bank credit grew by 18.6%. So, the retail loans grew at a much faster rate as compared to the headline credit growth, the overall credit growth, and that has also resulted in increase in the share of retail loans. So retail loans now account for 40%, more than 40% of the overall bank credit. It's a significant shift in the overall credit portfolio that we are witnessing. And
is this in itself a risk?
Itself, it's not a risk because, if we look at the NPAs, the retail loans NPAs is the lowest. If we look at, the sectoral NPAs, we've talked about the overall gross non-performing assets ratio. And if we divide it into, we'll analyze it in terms of agriculture, industry, and personal loan, we see that, personal loans NPAs is the lowest. So as of now, there is no problem. Personal loans are doing fine. The problem is that a greater share of personal loans are on an unsecured basis, because they are being advanced without any collateral or maybe at a limited collateral. So that is the point of concern that has been raised by RBI, initially in the form of a warning, and then they increase the risk weights just to, discourage banks to go at a very fast pace as regards the unsecured lending. So, and there again, here they are talking about the same concern that, the share within the retail loans, the share of unsecured lending has increased, and that has increased just within a span of 2 years. The share of unsecured lending has increased. The growth of unsecured lending has even been higher than the growth of retail loans. So, as I said, retail loans has been 25%. The unsecured loans has grown by 27%. So they are worried about not just the retail loan, but the fact that unsecured loans is rising at a much faster pace. And therefore, the share of unsecured lending within the retail loans category has increased within a span of 2 years. And that is true not just for banks, but also for NBFCs. So both banks and NBFCs are engaging in unsecured retail lending, which is a cause of concern highlighted by the RBI.
Okay, and yes, now it's great how you lead me up to my next question, because my next question was about NBFCs. We've talked about banks, but the RBI has raised some concerns about NBFCs and the interconnectedness of NBFCs and banks and how this is growing. Yeah. Now, first, let's start with what their issue is with the NBFCs are, and then we'll get to the connection with the banks.
Yeah, so NBFCs, the non-bank financial companies, they are of two types. Broadly, they are a very heterogeneous lot, and they have been playing a very important role in financial intermediation, in giving loans to the last mile, in giving loans to those segments where banks are not forthcoming. So they have been increasing their footprint in the credit business a lot over the last 2-3 years. Now, again, the problem with NBFCs is that currently currently everything is fine in terms of their NPAs. NPAs are low. The credit growth is good. Their balance sheet position has improved. But again, the problem is that they are lending at a very fast pace on an unsecured basis, which is a cause of concern highlighted by
So it's the same issue.
It's the same issue that, again, the retail lending, both by banks and NBFCs, retail lending has been rising. And within retail lending, it's the unsecured loans component, which has increased at even a faster pace, which is causing concern for the RBI. So therefore, RBI has increased the risk weights for consumer loans, unsecured consumer loans, and that applies to both banks as well as NBFCs. The point here is that within a span of 2 years, there has been a very sharp increase in the unsecured loan. And this is what is something, the question that we had raised was that, what are the financial risks going into 2024? This is something which is going to be something on the regulators' radar in 2024, because they have to see now what happens after the imposition of risk weights, whether there is some tempering or slowdown of unsecured loans or not, because that is something.
Are there any other steps that the RBI can take? Like, say, if they find that there is no slowdown in the growth of unsecured loans, what more extreme steps can the RBI take?
They can further increase the risk weights, and if they further increase the risk weights, that will hamper the capital position. Even now, it's not. It is an extreme step. It's not something that is not going to have a material impact. It will have a material impact on the bank's capital position, because they will have to set aside more capital if they have to lend to this category. And therefore, the capital position of banks is going to fall. And this is one thing that they have estimated in the report also, that, we should see the capital falling from 16.8 to 16%. So there is an 80 basis points decline in the capital position estimated because of this move. So it is, if they further increase the risk weights, it will have even a more significant impact on capital position and hence on profitability and so on. So given this, we will have to see now to what extent there is a tempering. Is there a tempering in the credit growth overall, or only in the unsecured component? So a lot of things will play out in 2024.
Right. And now, so far, I was given to understand that if NBFCs and banks were interconnected, then that only serves to help the NBFCs and makes them stronger. But it seems that the RBI is now saying that this growing interconnectedness could be a risk. Could you tell us a little more about that?
Yeah. So what has happened is that since 2018, we saw that there was a spate of crises in the NBFC segment in 2018. The most significant was the IL&FS collapse, the Infrastructure Leasing and Finance Services Company Limited collapse. After that, what happened was that the entire funding for NBFCs dried up, because normally what happens is that NBFCs raise funds and then they lend. So the business model for NBFCs is different from banks. They do not accept deposits, public deposits like NBFCs, like banks, like commercial banks. So NBFCs raise finance through the issue of bonds or through the issue of short-term papers like commercial papers. Mutual funds are one of the main subscribers of these bonds, and they were till 2018. But after this crisis, which led to there was a complete squeezing of funding for NBFC sector. And after that, particularly post-COVID 2021 onwards, we see that there has been a growing reliance of NBFCs on banks. So the bank borrowing became the major source of borrowing by NBFCs. Before that, it was the issue of debentures, and that's very aptly shown. It's a very lucidly shown in the RBI's report. They have a table which shows the source of borrowing, which we have also extracted in the article, which shows that now bank borrowing has become the prime source of lending, borrowing for NBFCs. Banks have become the key lenders. Earlier, it used to be issuance of debentures, but now it is the banks are the main lenders to NBFCs, and they account for 41% of the overall NBFC borrowing. So that is one shift that has happened, and it used to be, the share used to be 37%, and now it is more than 41%. So again, in a span of 2-3 years, we have seen a big jump in the share of banks in the overall NBFC borrowing. So both from the perspective of banks' balance sheet, NBFC share has increased, and from the NBFC's perspective, banks have become the prime source of borrowing. So now this growing interconnectedness could pose systemic risk concerns, because if NBFCs face some asset liability mismatch, because NBFCs are lending on an unsecured basis, if they face default risk, then they will not be able to pay back to banks, and then the risk that NBFCs are facing will spill over to the banking sector. Now, had it been just 2-3 NBFCs, it would have been fine. But given that the share of NBFCs in the overall bank lending has increased significantly over the last 2 to 3 years, that could pose system-wide concern. That is why they use the term systemic risk. So it's not just limited to, at a micro level, but it's now become a more macro concern. It's become a more financial system concern. And that is why it finds a place in the financial stability report, that it's a systemic risk concern due to the growing interconnectedness between banks and NBFCs. Another point is that, what happens is that banks are not allowed to lend to smaller NBFCs because of the regulatory constraints. But what's happening now is that banks are lending to bigger NBFCs, and bigger NBFCs are lending to smaller NBFCs to address, or to move around this, to play around this regulatory prescription. So that is, again, any vulnerability in the NBFC sector could then spill over to banking sector.
Right.
So that is a concern.
So, but how do you go about addressing something like this? If the root cause of the problem is that NBFCs are not being able to raise capital from other sources and so have to rely on banks, how do you fix this? Because the raising capital from other sources is a voluntary act. People have to be willing to invest. Yeah. If they're not willing to invest, how do you fix this problem?
Yeah, so one, they have already tried to fix this problem by again increasing the risk weight. So, one is the increasing in risk weights for unsecured lending. But the other is that the banks lending to NBFCs also now attracts a higher risk weight. So that is one way of discouraging banks to lend a lot to NBFCs. The other is that NBFCs would have to diversify their sources of funding. They would have to get into the bond market. They would have to issue bonds at a lower cost. As of now, they were also enjoying the lower interest rate regime, and they were able to borrow at a lower cost. But now they will have to diversify their sources of funding, because going forward, it will become problematic for NBFCs to rely on banks, because now, since banks are subject to higher risk weights, they will charge a higher interest rate from NBFCs. So NBFCs' cost of borrowing from banks will increase, and therefore they will have to shift to other sources of borrowing, which relatively could be cheaper going forward.
So overall, we could see in the short term at least a slight squeeze of capital for the NBFCs, because if they aren't getting money from the banks or the markets.
Yes, that is true. And that is what has been highlighted by a number of reports also, that in the short term, the cost of borrowing for NBFCs could rise. And that could again then spill over to their lending, that, their lending could also become more costlier. So it is going to have an impact on the NBFC business. And that is also something which has been highlighted by the Financial Stability Report, that while, banks are quite well placed under all risk scenarios, low, medium, adverse, but NBFCs in an adverse stress scenario, it could have an impact on on their balance sheet. So that is something that needs to be seen. It needs to be watched how this interconnectedness plays out in this year.
Right. And now we have talked about bank profitability. I've written about it. You've written about it earlier. And banks were doing quite well, or are doing quite well even now. in terms of profitability. But the RBI seems to feel that this might taper a little bit going ahead.
Yes, because of a number of factors. One is that, the agricultural loans from the agricultural sector is going to be subdued. And because of the subdued performance of agricultural sector, the demand for loans from agriculture could be slower. Also, given that agricultural NPAs is at 7%. Overall NPA is at 3.2, but loans from loans from agriculture is having a higher NPA at 7%. So that is one reason for slowdown of the overall bank credit. The other is the increase in the risk weights could lead to lowering of credit, and also, if this will have an impact on the profitability of banks, because the net interest margin will now start to squeeze because now banks, if they have to lend, they will have to offer a higher interest rate on deposits, which they are already doing. If you see over the last couple of weeks, we have seen a number of banks increasing the deposit rate on term deposits. So that will lead to repricing of the deposits. So the trail that we are seeing, credit, the loan rate is rising at a fast pace, whereas the deposit rate is not rising. But now we should see
that gap will shrink.
Will shrink in this year, and that will have implications for net interest margin, further having implications for banks' profitability. So not to say that bank profitability will turn negative, but the kind of record highs that we saw this year, we might not see in the coming year.
Okay. So there you go. Overall, none of what the RBI has to say is very, very surprising. A lot of it, we could all see coming. One is that the banks are in a strong position currently. They have been resilient to a lot of the external shocks, the internal shocks, but there are some emerging signs of stress. A lot of it has to do with the growth of unsecured loans. This is a sign of stress not only for the banks, but also for the NBFCs. And because the banks and NBFCs are becoming more and more connected, it's a source of stress to the entire financial system. Going ahead, banking profitability will still remain strong. It won't hit the record highs that we just saw, but it'll be a little lower than that. And that's because there are some emerging risks that are coming up, and the fact that the rates of deposits has to go up. It has to start meeting, maybe not meeting, but coming closer to the rates at which the banks lend. And so their profitability in that case will shrink, but not huge causes of worry just yet. This is just the RBI warning, laying out the groundwork, saying that these are the emerging risks. Keep an eye on it. If not, we'll have to take some steps.
Right.
But on that note, thank you so much for watching.